Good morning, Chris. How you doing?
Good morning, my friend Brian. How are you?
I'm doing great. This is Brian
Nice to see
Jones.
you.
I'm here with Chris Hood, professional trader, world's most interesting man.
Every time you say that, I honestly just have these words of my wife ringing in my head where she goes, "You're just so boring sometimes." So, it's nice to
Are
know.
you a spontaneous guy, Chris?
Um, when it comes to trading, sometimes yes, but most times I have a plan.
You plan spontaneity.
Absolutely. Planned spontaneity is the thing that you do as you get older. Like you have to plan everything from the shower to the bathroom. You got to plan it all. So,
I'm kind of the same way. I'm not inordinately spontaneous. I I like to plan my chaos. Like I like to do crazy stuff, but only at specific times and in the context of a larger discipline system.
oh man, I think what would you say? Unplanned chaos can sometimes wreak havoc the older you get, because that often results in twisted knees and broken fingers and things. If I just applied it to jiu-jitsu, could you
Right.
imagine going into a match with no plan and just spontaneously being chaotic? I think I might land up on the ER table.
Getting together with some of your friends, having a bunch of drinks and grappling in the sidewalk.
Yeah, sidewalk grappling. Yeah, not my thing. I haven't really done much of that in my life. So no. No, you know what? It's a really interesting thing. I think a lot of traders tend to forego the idea of planning and think that they can spontaneously try and beat machines. And that's where problems start to come in. Machines don't have that emotional connection to trades. They trade formulas and they trade setups and specific pieces of data. And humans tend to be a little bit more emotional. We've got that greed thing that goes on, and we've got the fear thing that goes on. So
Yeah,
planning is really important, like especially for trading.
emotions. There's a lot of nasty emotions.
Oh yeah. I
I
mean, red brings out the most. You've always got to remember this, right? When people design trading systems, they design them to make them a little bit more like a game. And when you gamify stuff, then you've got this red and green all over the place. And people tend to have this a negative reaction to red and a positive reaction to green, but never to the same degree of emotional intensity. When things go red, people think it's the end of the world. When things go green, they go, "Oh, it could be better." They
well,
never have the same reaction. So,
I mean that people respond more negatively to loss than they do to losing profits is
yeah.
robust. I mean, people don't like to lose.
No, and that's why often strategically, if you don't have a trade plan that allows you to look at both sides of both trading in red and green, it can drive you a little bit insane. And that's why people tend to make decisions at the wrong time. You often hear the expression shorting in the hole. The market's already moved 5 ATR and then they start shorting it. You're not going to make money that way. If anything, you're going to get killed on the reversal, which is inevitable, right? Those things happen. So a lot of times people sabotage themselves. I think a lot of retail traders get sucked into sabotaging themselves because of that lack of planning. So if you don't have the tools or the skills to plan properly, your trading pretty much becomes random. And that randomness is dangerous, because I always try and say to my clients, you've got to be careful about imposing your thoughts and thinking onto the market, because the market really just doesn't care. Like, no one really cares what you and I think. What we have to do is look at what the market presents us and make unemotional, unbiased choices, whether we engage with the market at that point. One of the things I try and use is I describe the market as a child on crack and sweets. If you gave a 5-year-old some crack and chocolates and what have you, and they were coming off a high, they would be pretty emotional and pretty moody, and they'd be all choppy, and you wouldn't know what kind of market you're dealing with or what kind of kid you're dealing with. But you as a trader choose to engage with that, right? And if you choose to engage with the intention to impose your will on the market, right? This trade must work, because, and you don't put your lines in where, the lines in the sand where you say the trade is broken or whatever, you could be in trouble, because that causes the emotion of, I'm going to hold on because it's going to work. I was right. I have to trade to be right. And traders who trade to be right rather than trade to be profitable tend to be inconsistent. So, we built a couple of tools that help people develop that consistency of emotional control. That's the most important thing as a trader. If you want to look at trader's edge, people, most novice traders think it's an indicator. They think it's a signal. They think it's a little green bar that pops up on a screen telling you to do something. That's not trader's edge. It can contribute to trader's edge, but it's not trader's edge. Trader's edge is the way you interpret pieces of data that fit together, that come to an agreement of a conclusion from different angles. So they look at different pieces of data, but they come to the same answer. That's how you create edge. But, it's one of the saddest things when you look at trading, when people go, trading's too hard. It's not that hard. What's hard is the discipline required to follow a plan. Trading by itself is pushing keys, and, that's, not difficult at all. But the planning and the build up to it is, it's a lot of work.
Well, most people don't want to put work into anything. They're all about something until they realize that they actually have to do some work, and then it's the same, for the same reason that fitness equipment is mostly used for hanging your clothes on at the house. The stuff that people buy this machine, it's like, oh, that's enough. If I had this thing in my house, I would work out all the time. It's like, no, you won't.
Yeah, I've seen that a lot with traders. It's traders, if you look at the way information is marketed today, I know I bring this up all the time. I clicked on one thing on Facebook and now I'm inundated with a whole lot of marketing about, you only need this and you only need that. And, 5 minutes a day is going to make you a billionaire and you're going to get a, really nice Bugatti at the end of this. I think that's so misleading. Trading is hard work. The bulk of the work that I do when it comes to my trading happens after hours or before the market opens. It doesn't happen during the day. There are days where I sit and do nothing during the day because none of the setups that I was looking for actually materialized. And then you go back to the drawing board, start all over again, and you continue to do it. But I think a lot of people have a misconception about the simplicity of trading. We shouldn't underestimate the requirement or the need to have tools that will help you analyze things in such a way that it will drive you to a proper decision. There's no one indicator that is better than another. I do make a distinction, though, in my trading between lagging indicators and leading indicators. And, if your trade plan is built off lagging indicators and you don't even know what a lagging indicator is, you'll be inconsistent because you'll be trading on signals that generate on data that's old. You'll have nothing that's forward looking. If you base your stuff on, I saw this once, you go into Amazon and you buy a book on trading and they'll tell you, this is the setup. This is the holy grail. It's a $9.99 book on your Kindle. And this is it. You don't need anything else once you've read this book. And people believe that, right? They'll go in, they'll read the book and they go, okay, that's it. I'm forever going to be doing an 813 SMA crossover regardless of the stock. But they don't know that the 813 crossover has never worked on stock A, but it's worked on stock B. And the only examples that they've shown you in the book are the stocks that it happened to work on, not the ones that it didn't. And this is where a lot of traders go wrong, is that a signal is a signal. It doesn't imply that you've actually followed it, because people don't behave like that. They get a signal and then they start doubting. What if it's wrong? What about if it does this? And then you start questioning the validity of the signal. A lot of signal indicator vendors never provide backtesting information. So they don't tell you how good that signal is. They'll give you a graph on a screen and it's going up and you see, look, it went green over here and the market went up. That's 1 out of 8,000 stocks. And you've got multiple time frames. it's very easy to manipulate your impression of something when there's no validity on the history of it, right? You can't see that it's worked. You know, it might have given 5 million signals before, they were all wrong. You don't know, right? So a lot of people get sucked into that game. And that's a bit of a pity, because I think a lot of people lose money because of those marketing tricks. You know, it's just the way the world is now, unfortunately. There's always a hack, you know.
What do you think about this? Do you think we're still going to see a good tech rally? I know it's pulling back a little bit.
Yeah, you know, let's play around a bit and see what we've got. So let me open up my screen.
Bullish on semiconductors.
Yeah, let's have a look and see semi. So let's open up the market first, have a look and see where we are, and we'll take it from there. So let me share the screen. Where is this thing? Here. Okay, so let's have a look at where the market is. All right, so here we are, top corner. Okay, the top graph at the back here. S&P 500, right? We broke the 21. We've already, you know, we've had signals to get out of our trend. You know, we had a scale in instruction here back on the 13th. That was yesterday, and we took profits on the candle yesterday afternoon, right? So there was a little bit of a trade here. This is the 1 hour chart here on the S&P. We're coming down to the hourly 55, right? So this is a key level. At the 55 is where a lot of the institutional algorithms will start to come in and support the price. So I'm not that concerned about this sort of price action. That's not too concerning for me. What I do look at as well, let me open up a chart here. Here, let's have a look at the put-call ratio. So here, this was that rebound that we saw from the 6th of December, 3rd of December, this rally that took us from minus 180R up to plus 180R. That was this movement from here, right? We broke the 10-day moving average, but you see the 10-day moving average of the put-call ratio is still rising, right? It's still trending in this direction. Now, we will see this chop. We will see this movement around there. We see profit taking, came down. It's now chopping here. We could see it go this way. We could see it go this way. We've got the Fed, right? So we've got an event tomorrow, I think it is, that could generate the put-call ratio to go this way, or it could cause it to go down, right? So we're sort of sitting in the middle at the moment. Do I think there'll be a rally? You know what? Whether there is or isn't shouldn't affect your trade plan. You know, you shouldn't trade around the probability of the seasonal rally taking place. I don't think that that's the right way. What you should do is look at the charts and say, where are we right now? Is there a setup? Is it valid? If it's valid, you trade it. If it's not valid, you don't trade it. It's that, it really should be that simple. It shouldn't be a matter of, well, I'm not going to trade anything because Jerome Powell might say something, and then you miss whatever the opportunity is that comes out from that. So I think that we're going to be sitting here. Maybe today we'll see a little bit more sideways action until tomorrow. Maybe we'll see a rise up into next end of the week. If I pull out my trusty little almanac.
The Fed's making their announcement tomorrow, correct?
Yeah, and don't forget, we've also got triple witching on Friday. We've got the end of the month. We've got the option expiry. We've got futures rollover. We've got all of these things happening. And if I look at my trusty almanac, if you haven't got one, you should get one. It's available from stocktradersalmanac.com, and it looks at the seasonality patterns that form, per day of the year over the last 50 years. If we look at it, today's a pretty flat day. Tomorrow is bullish. Thursday is bullish. And then Friday is bearish, right? So, doesn't mean it's going to happen, but knowing that for context is really important. If we look at the sectors, so let's pull out the sectors. So I was mentioning this yesterday in the 30-day income acceleration webinar that, last Monday, we had a sea of red. A sea of red. We had nearly every single sector sitting below the 8-day moving average. We've seen a bit of repair happening, but we've got a lot of sectors that are negative, right? We don't want to be near biotech. We don't want to be near XLC. Let's leave Google out for the second, right? So Google is a main component of XLC. What's happening here is Facebook is getting absolutely trashed, and so is Disney. So we don't want to be trading there, but Google still has a high degree of relative strength. Healthcare services doesn't look too good. Oil and gas switched very quickly. Natural gas as well looks bearish as well. But the three that are really good, technology, home builders, and semiconductors. Those are the three areas where I think that there's still opportunities. We've still got trades in them. XLK, pretty much Apple, Microsoft, NVIDIA. Home builders as a sector, I think ITB is a slightly better ETF to trade than XHB. And then SMH, we use SOXL, which is the triple leverage semiconductor stock. We use that as a proxy for that sector. I like this. Here you've got XLK offering some good strength. We've got XH or ITB as well offering some strength. This below the 8th is slightly concerning. It will give us, though, in a double green market, when we fall below the 8, it gives us an opportunity for a good entry. All right. It might give us some short term, like over the next couple of days, some negative momentum. And if this continues to break and it breaks the 21, we want to get out of the trade. So making sure that you've got your stop losses in place, that you know your line in the sand of where you want to get out. If you decide you want to do a 6-month trade with this and you average in, know where you're going to be averaging in. So if we take XLK and we go into the sub stocks of XLK and we just break this down a little bit, we go into XLK as a group, you can see the strength of Apple, Microsoft, right? You can see that. There is the ETF by itself as well, offering a really good setup with quite a long squeeze that's been compressing there for a while. And the stocks that you want to be watching are Cisco, Intel. Those two have got potentials to be repaired, although Intel needs to do a lot of work to get back above the 21. So Cisco looks pretty good. Looks like we could get something here if we get the 34 to cross over the 55, or sorry, the 21 and the 34. The other ones that I like NVIDIA, but it did break the 8 yesterday, so we need to be careful there. But Apple, Microsoft, for sure. If we look at the actual trades we have on Apple, so here on Apple, let me go into a bigger screen. So here is Apple. We've been doing trades in Apple since our first signal we received on the 21st of October. Now, this is a tool that we've built, and we are trading a particular type of strategy here on Apple, right? So what we do is we look for conditions that have been proven in the past to be successful, all right? We wait for signals to occur on that basis. So what we're always looking for is high win rates and high profit factors. These are really important because you can have a low win rate, but as long as your profitability factor is high, you can still make money. When you get the two of these together, we know that that's a strong setup, right?
What's that? Profit. I like that profit factor.
Yeah, it's an awesome trade, right? So what we do is we trade larger, longer term strategies here. So when we open up our tool, what we can do is we can actually see from here, what we're trading is a 9-14-21 momentum reversal together with a candlestick reversal, right? This is not just a moving average reversal of price. It's actually a candlestick reversal as well. And we're not doing any add-in entries, all right? We're trading add-in entries on a slightly different basis using a volatility band. So when we use a volatility band on our trades, what we do is we manage the way in which price can move, and we also make sure that our system keeps us out of trades when they start becoming too volatile. All right, so we've narrowed our range of volatility on Apple. We've got a 2 to 4, a sort of double R risk calculation. And what we're using here is a 2 ATR trailing stop loss on the trade. Now, remember this as well. We're trading a option on a stock, but we let the stock guide the trade. All right. Remember, an option is a derivative, right? So you always want to go to the original asset and then trade it from there. One of the features of our tool is we can always click on our strategy info button, and what it will do is bring up how to manage the trade over here in, these are our different strategies and how we're going to exit, etc. If we are using bull put spreads as our main strategy, or long calls, whichever the strategy is that we're following, right? So this is our trade setup that we have on Apple. Now we've got 75% win rate. When I go here with a 4 ATR trailing stop, if I drop that to 2, make it a 2, it's going to change this a little bit. So there we go. So now I'm at a 70% win rate with a 17.5 profit factor, and now I'm waiting for my strategy exit signal. When I get that signal, I close down the trade. All right. Now, this trade here, we also have a squeeze that fired long, B score above 50, and our alpha score moved into that range of being green. So we had a lot of confirmation signals that were happening despite the fact we were below the Ichimoku cloud at the time of entry. Now, when we see these scaling in instructions, all right, we have an opportunity to take pieces of profits off our trade at the same time. So while we're still trading a longer trade, waiting for a signal to come in there, we've also got these signals giving us individual trades as well. So,
so do you
this is how we plan. Yeah.
I have a question. So on a stock like this, where you're sort of playing the long-term trend, and you're doing, are you doing one longer term trade on the whole trend and then several shorter term trades within that?
You can. Yeah, you can. So for example, here, where you see this gray line over here, this was a take profits line. There was our profit level that we had predetermined once we entered this trade. So when we got here, we took quite a lot of profit off the table. All right. We didn't have an ATR break of the trade, right? We didn't have a volatility break. So we could still maintain our exposure to the trade because we'd hit our profit target and we were still trending in the right direction. The sub-graph indicators were still indicating bullish strength and bullish momentum on the trade. So we stayed in the trade. We don't have to get out when we see this gray column come in place, unless the stock is actually breaking a volatility band. So for a trader who trades off a system like this, you could literally be buying shares on these signals and trading options on these signals. You could be trading options on these signals and adding to that position when you have a scale in instruction. So you could do 1/3, 1/3, 1/3, take out 1/3, etc., etc. There's different ways you can play it. It depends on you as a trader. What we try to build here is something that's a lot more consistent in terms of the signal. So when you build your trade and you say, look, I'm trading Apple, I know that I only get this signal 10 times in the last 3 years, right? So over the last 2 years, it traded only 10 times. Each trade average duration was 25 days. So if I'm going to be trading this, I need to understand how frequently the signals are going to be generated, number one, in terms of the duration of the trade, not just when the signal will appear on the clock in terms of time of day. And then I also need to have these below chart indicators giving me confirmation. All right, you've got to know the strategy that you're going to follow. So one of the things that we try and do when we plan our trades is to understand exactly what you're going to do when you get the signal. It is not useful to any trader, all right, to get a signal and go, okay, all right, what am I going to do now? The market moves too quickly. You might be deciding, okay, if I get that signal, I'm going to buy more shares. Okay, that's fine, buy more shares. But if you go, I don't know if I should buy shares, buy a long call, should I do a bull call debit spread, should I do a butterfly, should I sell a put spread? You're going to get confused. It's going to land up being a bit of a mess. So we try and plan this ahead of time and say, okay, when I get my next take profit signal, because that will be the next profit, the next signal will be a take profit signal. When I get that, I'm going to close down some of my bull put spreads. I'm going to continue to hold my long call options, which are very profitable now, that we entered over here. And I'm going to continue to hold my shares, right? So I'm trading this until Apple breaches these lines. When it breaches these lines, I have alerts that are already set up here. When Apple breaches that line, I'm going to start taking off some of the profit that I've built from the position that I put in here. So I know exactly what I'm going to do when it happens. All right. And I've written it in the alerts. And when I get the message from the system, it will tell me exactly what I said I was going to do. I go off and I do it. So this is just one example of how this tool works. It stops you from being random. It helps you understand the setup and whether that setup has made money or not in the past. That's really important. So as a trader, what you want to know is whether or not your setup that you're trading is actually going to work. So let's do another one here. Let's look at Proctor Gamble. All right. So Proctor Gamble came out today. You know, if I go back to my screen here and I go to XLP, Procter & Gamble is a big component of XLP. XLP is rising in price. And if we look at Procter & Gamble here, PG, you can see green, weekly squeezes fired, 30-minute squeezes happening. I've got entry signals all over the place. But the question now is, is Procter Gamble a reasonable trade at this point, right? So if I go into my Procter Gamble setup, the first thing I want to do is I want to make sure that I'm trading the right entry strategy. So we click on one tool here, and what this will do is it will assess whether or not Procter Gamble on a SMA basis, which one of the SMAs is the best entry signal to take, right? So let's give it a, let's put it on. There it is. So from here, I can see the 8, 13, 13, 21, 21, 34. I can see all of them there. And I can see that none of these are particularly profitable. All right. This is just a basic trade assessment of that entry signal. It's telling you whether or not that entry signal has worked in the past up to 2019, what was the win rate and what was the profit factor. Now from there, if I change that and I go look at the EMAs, all right, we saw nothing here on the SMAs that made us, excited. Let's have a look at the EMAs and see if the EMAs made any sense. Let's see, it's going to change in a second. Takes a little bit of time. This was quite a complex thing to write, but now we've switched to the EMA, and not one of the EMAs as an entry signal on any time frame on any of these crossovers was actually profitable. So if you were trading an 813 EMA crossover on Procter & Gamble, and you didn't know that that signal doesn't have a very good win rate and is not very profitable, and you mess up on the trade, you're going to look at it as a trader and go, I'm a bad trader. And you're going to look at it and say, well, I need to fix what I'm doing. You don't realize that it was your entry that was wrong, and it actually never had a chance of winning because it never has. Or it's got a very low probability of winning, right?
So just a question.
Got to first identify. Yeah, sorry.
So I have a question about back testing. The question is always like, how far back should you back test? For me, like what's a reasonable amount of time to back test and to sort of capture different market conditions? And
I usually go 2 years, Brian. Like 2 years gives me cycles, right? Now, remember, if you're going to back test something, you go back to 2008, okay, you get these big market collapses, right? You get those big 2008, 2012, major events. 2 years for me as a trader is pretty reasonable. But I certainly wouldn't back test it a week or a month.
Right.
That's too short, right? So 2 years is pretty much enough. And what you find is that, most strategies over a week to a month can work, right? Most of them can. When you start increasing it to 2 years, what you should be looking for are win rates that are above 50 and profit factors above 1.4. That's what I'm looking for. If I can get something like that around 2 years of back testing data, if that's what the win rate is and that's what the profit factor is, I'll be interested. All right, I'll be interested. The thing is, with a lot of stocks, what we don't realize is how some of these stocks' personalities do not tie up to the moving averages, right? So it's very, very easy for me to come to you and say, hey, Brian, the 813 crossover works really, really well on this stock, and show you that it worked, right? And then you go, yeah, I don't like that stock. It's overpriced. So I'm going to go to this stock and I'm going to trade it on that same basis. And you don't know that it doesn't work. So what we found was, you take setups on, some of our big stocks that we trade, Google and Amazon, for example. What works on Google does not work on Amazon. You can't trade them the same way, right? They have to be traded in a slightly different way. And, once we've identified our entry mechanism and what we are going to be trading on, and where, if we know that this signal, in fact, let me pull up Google, because this is a little bit easier to read. Here, when you look at Google, if you knew Google, the setups on Google had an 80% win rate over a 3-year period or 2-year period. Okay, since 2019, let's push it back even more. Let's go back to 2017 and see where this goes. And what you do is, if you knew Google, it's even better, right? The further back I go on Google, the better it gets, right? So here's Google. If I've got a trade that I know over the last 4 years has only generated 40 trades, so I know it's going to come 10 times a year, all right, on average, 10 times a year, and I'm going to have an 80% chance of winning. And when I win, I'm going to make 9 times more than what I lose, right? And here's the big kicker when it comes to trading a plan. You have to know what your worst case scenario is. In the last 4 years, just trading Google on this basis of setup, your worst P&L at any given time was minus $1,900. But over the 4 years, you accumulated $78,000 of profits, trading a very, very small position just on the stock.
And this is based off of a $100,000 account using like
2%, yeah, $2,000 trade with pyramids of orders, right? So what we do is when we pyramid, we say, I'm going to add in an extra 2 orders every time I have entered on a major strategy signal, right? So on this basis, what I would want to be doing is making sure that I've selected my secondary trade. So my secondary trade, my entry is a reversal. My secondary trade is what we call a slingshot. So I've got the slingshot in, it's these extra green columns, right? So when the conditions are met for a slingshot, a green column will appear and I can enter on that column, right? I can enter my second trade. These numbers are based then on 3 trades at a time. So you're using a maximum of 6% of your equity at any given time. So this is a really powerful trade setup.
Yeah.
So you don't want to miss the opportunity to trade the setup when Google hits this entry. So here we got an entry 2 days ago. We're at the 21. We're in the buy zone. We're between +1 and -1. We're on the point of where Google has proven in the past 4 years to be a great entry point for a trade. So this is where you would say, okay, well, what am I going to do? Am I going to buy shares? Am I going to buy a long call? Am I going to do a bull put spread? Whatever it is, right? So I trade a lot of bull put spreads on Google when I get these signals. So, you know, you'd be looking to use a -1 Keltner level as a short strike for your put spread. You could be using a -2. You could be using the Ichimoku cloud. This is where
you mortgage your house and you just go all in, right?
Well, I wouldn't suggest that as a good idea, but you've got to build a plan, right? You've got to know what you're going to do when that happens on the stocks you want, right? Let's take Tesla, for example.
But there is something to the more powerful the setup, the higher the profit ratio, then
the more you can commit to the trade. Yeah. So if you were looking at this in a jiu-jitsu context, if the guy's giving you the arm, you don't go for a neck, you don't go for a neck strangle. If he gives you the arm, you take it. This is one of those situations where Google's giving you the arm. This is where you're going to get your arm bar from. So here, what you want to be doing is making sure that you have a proper strategy in line with Google. Now, the thing that we also got to look is down the line. We have a slingshot squeeze forming. Our stochastic indicator here on the squeeze is telling us we've got a low compression squeeze. Get ready. Our B score is above 50, but it's looking like it will crack the 50 line to the downside. All right. That might mean that we could get a cheaper entry into Google somewhere around here over the next couple of days. If this strategy signal, if you look here, this strategy signal will take a day or so to activate, right? So we're not going to get a signal intraday. It will take us a day or two before we would get our exit signal. And this might be a trade where, okay, that was a false entry. We get out, it tells us to get out, and we wait for the next signal. All right. It doesn't mean that the strategy is wrong. It just means, look, we know we're not going to win every time. And we just have to accept that. That's the way trading works, right? So from here, you can look at Tesla, let's say. Let's look at Tesla. Tesla here, there's no trade. We don't want to be trading anything on Tesla until such time as Tesla gets back into a buy zone, right? So we know we're going to get a scale in buy here at around 1100. Look at the validity of the signal. 70% of the time, it makes money with a profit factor of 11, 20 trades over 2 years. So we know we're going to get 10 trades a year. Okay, we're going to get 10 trades a year here on Tesla. Wouldn't you rather just wait until you get the signal and then trade the signal? Yeah. It just makes more sense, right? So the tool is really designed to stop you from chasing trades that don't exist. You can build your alerts, and it allows you to trade your plan. It's more important to trade the plan and trade a signal that's conducive to winning rather than just trading random, stuff out of a chat group, for example. I'm really against that stuff because you don't know the setup that these people are looking, and everyone interprets data differently. So, you know, you get on a chat group with 50,000 people and one guy comes up and says, guys, GME. I mean, I was looking at this last night. You know, let's look at GME quickly. I'm just going to put this in here for laughs here. You know, these stocks are dead, right? These stocks are all dead now.
I thought that one was going to 1,000. That's what all the chat groups said.
And that's why we don't listen to chat groups, my friend. You know, this is.
What about what about AMC? Let's see.
AMC also got hammered yesterday. Let's have a look at AMC. Yeah. You know, you could have traded it. I mean, look, you can trade the stock, but, you know, there's some poor guy who paid, what's that, $72. You just don't want to trade this stuff, man. It's all just nuclear waste. You know, if you build a proper trade plan on things like Google, you can build a proper trade plan on things like Microsoft. You know, this is where you're going to make, and, you know, you can trade on Apple. These are the stocks that are going to make you money consistently over time. You know, what's not going to make you money is trading garbage. You know, so this tool and the way that we use it is pretty much there to help you plan. It's there to give you the signals. It does the hard, heavy lifting for you. You build your strategy. You know that the strategy has got a high probability of winning. When it comes to doing the right strategy in terms of the option trade, that's a matter of experience and skill, as opposed to, oh, you know, I'm going to trade a long call when I get this entry. Don't do that. Rather get your entry right, build your chart, build your strategy, and then say, okay, the trade that I'm going to do is going to be a bull put spread. And you would click on the, you know, you'd click on the strategy. There's your bull put spread. It will give you the information as to what you should do with a bull put spread. Another thing that works really well with this tool is understanding the impact of trying to short the market. You know, a lot of guys go, oh, you know, let's just short things. And when you select this and you say, I'm going to short Apple, let's have a look and see how shorting Apple has worked together with going long, right? So now we've got both sides of the trade. Let's see what happens when we go long and short. The bells have now gone. Long and short, look at how it affected our profit factor. You know, shorting the market and shorting something, it's a tough game, man. You don't want to play that game. It's not worth it. So this is just part of the toolkits that are available to people as Rogue subscribers. So if anyone is interested in getting access to tools like this, you know, sign up to Rogue. There are special deals that I've got available for you if you want this as a tool. You know, it's just part of becoming a better trader, is to have tools that are going to help you become a better trader. So, you know, hopefully this gives people a sort of sense that there is light at the end of the tunnel, and it's not a train.
Sounds good, Chris. Well, we'll let you get on with your day there, and I appreciate your info.
Awesome. And guys, if anyone's watching, if you want to get in touch with me, please get in touch with me. Put it in the comments below. You can get in touch with me through rogueinvesting.com, and we can sort something out for you.
Absolutely.
All right. Take it easy, man. I'll see you next Tuesday.
Hey, yeah, Chris, take care, buddy.
Cheers, bud. Bye.